What if I told you that a company whose mascot was a talking sock puppet selling dog food online was once valued at $300 million, and that it bought a multi-million-dollar Super Bowl ad, even though it was designed to lose money on every single sale it ever made? This isn't fiction. This was the dot-com bubble, a 5-year period in the late 1990s when the financial world abandoned every rule of common sense and turned the internet into a giant, speculative casino. In a single, euphoric blink, fortunes were made from nothing. Then, in less than 3 years, $5 trillion in wealth was vaporized. The real mystery isn't that it crashed. It's why smart people, from veteran investors to everyday employees, fell for the oldest trick in the book, the belief that this time is different. To understand how the internet boom became a financial disaster, we have to look at the intoxicating narrative that silenced all warnings. The fuse was lit in August 1995 with the IPO of Netscape Communications, the web browser company. It was barely a year old, it was losing money, yet its stock price doubled on the very first day, giving it a valuation of nearly $3 billion. The message screamed across Wall Street: forget profit, focus on potential. This created the mantra of the era: get big fast, GBF. The strategy was simple: flood the market with cash from eager venture capitalists and IPOs, spend relentlessly on marketing to capture mind share, brand recognition, and worry about how to actually make money later. Because in the new economy, being the first meant you'd be the only. This frenzy was fertilized by 2 key factors: cheap money. The Federal Reserve kept interest rates low throughout the 90s, pushing money away from safe bonds and into risky, high-growth tech stocks. The narrative. Analysts declared that internet companies were different. They were asset-light. They were disruptive. And traditional financial metrics like the price-to-earnings ratio, PE, were suddenly deemed obsolete. Everyone wanted a piece of this revolution. Any company with a .com in its name, whether it sold pet food, groceries, or enterprise software, could raise millions. By 1999, the market was fully intoxicated. The delusion reached its peak in the stories of the doomed e-tailers. Take Cosmo.com. They promised free 1-hour delivery of everything from coffee to movies. No minimum order. They spent a fortune on couriers, bikes, and logistics in high-cost cities, completely ignoring the fundamental principle that you can't run a delivery service that loses money on every single delivery. They were chasing mind share, assuming that profitability would magically appear later. Or Webvan, the online grocer. They raised over $800 million to build huge, expensive, automated warehouses across America before they proved the concept even worked in one market. They were building an empire on the assumption of success. By early 2000, the NASDAQ index's average PE ratio had soared above 90, meaning investors were paying $90 for every dollar of actual company earnings. The peak arrived on March 10, 2000, with the NASDAQ cresting at 5,048.62. But the cash-poor companies that were only burning investor money were about to hit a wall. The pin that popped the bubble wasn't a single event, but a rapid, chilling shift in sentiment, fueled by a single reality. The Fed had started raising interest rates. Higher rates make borrowing expensive and make safe investments attractive again. The easy money that sustained the profitless companies suddenly dried up. Investors stopped asking, How fast can it grow? And started asking, when will it make money? The answers were brutal. By the end of 2000, the NASDAQ was down nearly 40%. Pets.com went bankrupt just 9 months after its IPO. Webvan collapsed in 2001, burning through its $800 million. Even industrial titans were crushed. Cisco Systems lost over 80% of its market value.
By October 2002, the NASDAQ had lost over 77% of its value from the peak. It wiped out trillions and created a lost decade for investors, with the index not recovering its high point until 2015. The dot-com crash was a great purge. It destroyed the reckless companies and left only the survivors, companies like Amazon and eBay, who, though they lost massive value temporarily, had real, scalable, and ultimately profitable business models that focused on customer value over marketing hype. It's easy to look back and scoff, but the patterns of the bubble are repeating right now. History doesn't repeat exactly, but it always rhymes. Today, the transformative technology isn't just the internet, it's artificial intelligence, AI, the cloud, and fintech. The narrative is just as intoxicating. AI changes everything, and these companies are monopolies. Here's the shocking parallel data. Valuation. While P/E ratios aren't as high as 90, the price-to-sales P/S ratio, a measure that values a company purely on revenue, has at times recently surpassed the level seen in 2000. We are again valuing revenue growth over actual earnings. Concentration. In 2000, the tech sector made up a massive chunk of the market. Today, the handful of mega-cap tech firms, the companies driving the AI revolution, account for an equally or even more concentrated percentage of the total stock market. The funding. Just like the cheap money of the 90s, recent low interest rates and the boom in retail trading has fueled waves of IPOs for companies with no profits, relying on the same old assumption: we'll figure out profitability later. The difference between a Webvan and an Amazon wasn't the idea, it was the economics. The difference between a doomed tech hype stock and a modern titan today is the same. Innovation is real, but speculation is fatal. The technology is not the business model. Innovation is great, but a great company needs a clear, defensible path to making more money than it spends. Fundamentals always return. Ignore cash flow, ignore profit, and ignore PE ratios at your own risk. Value always returns to reality. Timing is everything. The vision of the internet won, but the early speculators lost. Being right about the future doesn't protect you from being wrong about the price you pay today. The next technological revolution is here, but the human temptation for greed hasn't changed. The only question is, are you investing in a revolution, or are you just chasing a bubble? If this history lesson made you look twice at your own portfolio, hit the like button and subscribe for more deep dives into market psychology. Let me know in the comments, what modern-day technology company reminds you the most of the dot-com era?